In the year 1157, the Republic of Venice was in the midst of war and in desperate need of funds. It wasn't the first time in history that a government needed to borrow money to fight a war, but the Venetians came up with an innovative idea. Every citizen who loaned money to the government was to receive an official paper certificate guaranteeing that the state would make interest payments. Those certificates could then be transferred to other people, and the government would make payments to whomever held the certificate at the time. In this way, the loan that an investor made to the government essentially became an asset, one that he could sell to another investor in the future. This was the first real government bond. The idea ultimately created a robust market of investors who would buy and sell these securities. When a government's fortunes changed and its ability to make interest payments was in doubt, the price of the bond fell. When confidence was high, bond prices rose. It's not much different today. Governments still borrow money by issuing bonds, and those bonds trade in a robust marketplace where countless investors buy and sell on a daily basis. Just like the price of Apple shares, the prices of government bonds rise and fall all the time. One of the most important factors affecting bond prices is interest rates. When interest rates rise, bond prices fall, and when rates fall, bond prices rise. This law of bond prices and interest rates moving opposite to one another is as inviolable as the laws of gravity. Back in the 12th century, when Venice started issuing the first government bonds, interest rates were shockingly high by modern standards, fluctuating between 12 and 20%. In France and England, rates would sometimes rise beyond even 80% during the Middle Ages. Needless to say, it didn't take long for banks to get in on the action. They realized very quickly that by controlling government debt, they effectively controlled the government. The dominance of the banks over the government cannot be overstated. Miriam Beard's book, History of the Businessman, for example, describes medieval politicians in the Italian city-state of Genoa as having to pledge loyalty to the banks before they were allowed to take office. Thus began the deep, long-standing relationship between banks and the government. Banks buy government debt, helping to finance spending packages that keep them in power, and the government bails out the banks when they get into trouble. You scratch my back, I scratch yours. All along the way, of course, they both use other people's money, your money. Governments bail out the banks with taxpayer funds. Banks fund the government with their depositors' hard-earned savings. Of course, it's so absurd now that they've simply resorted to creating money out of thin air to benefit both of them, which is precisely what central banks do. A decade ago, during the 2008 global financial crisis, central banks around the world created trillions of dollars, euros, yen, etc. worth of currency, and effectively gave it all away to their respective governments and commercial banks. In the US, the Federal Reserve conjured $4 trillion out of nothing and loaned, as they say, most of it to the federal government at record low interest rates. But here's the weird part. Remember that inviolable law of bond prices? When interest rates go up, bond prices fall? That's exactly what's been happening. The Fed bought trillions of dollars worth of government bonds at a time when interest rates were at historic lows. Then, starting about 2 years ago, the Fed began slowly raising interest rates. But each time the Fed raised rates, the value of the government bonds that they had purchased would fall. This seems insane, right? By raising taxes, the Fed was creating massive losses for itself. As the Fed continues raising interest rates, it will eventually engineer its insolvency. Well, that's now happened. Last week, the Fed released its latest quarterly financial statements showing that the value of their bonds is now $66.5 billion less than what they paid. That $66.5 billion unrealized loss is far greater than the Fed's razor-thin $39 billion in capital. This means that on a mark-to-market basis, the largest and most systemically important financial institution in the world is objectively insolvent. It's also noteworthy that the Fed's financial statements show a net loss of $2.4 billion for the first 9 months of 2018. This is all truly remarkable and highlights how utterly absurd the financial system is. Our society has awarded an unelected committee the ability to conjure trillions of dollars out of thin air and render itself insolvent to support the ongoing mutual back-scratching of governments and banks, all at your expense. But what's even more remarkable, though, is how little anyone has noticed. You'd think the front page on every financial newspaper would read, "Fed insolvent." But it's not. No one seems to notice that the Fed is insolvent, or, for that matter, that most Western governments are insolvent. It's crazy. It's as if it doesn't matter that the government of the largest economy in the world loses $1 trillion a year, has $22 trillion in debt, 30+ trillion in unfunded pension liabilities, or suffers a debt-to-GDP ratio in excess of 100%? Or that the central bank of the largest economy in the world is insolvent on a mark-to-market basis, according to its own financial statements. There seems to be an expectation that none of this matters, and it will continue to be rainbows and buttercups forever and ever until the end of time, despite some of the most compelling evidence to the contrary. It's difficult to imagine a consequence-free future with data like this. Peaks, corrections, crises, etc. are often preceded by similar dismissive, willful ignorance and irrational optimism. It would be foolish to presume that this time is any different. I hope that one of the advantages you find with receiving the wake-up call twice a week is that you get to understand future events in advance. For example, the current downturn in the markets should not come as a surprise to you in the least. You have been prepped for this for a very long time. The timing is always impossible to predict with all but the vaguest accuracy. To be honest, I don't know the reason for this. I can take actions personally which will ensure my bankruptcy, and if I want to do so, I can time them to coincide with bankruptcy with total accuracy. Yet, with the economy, there are so many variables that it is impossible to do this, and anyone who tells you that that's not true may not actually be lying, but they are grievously misguided. Neither can you rely on the markets to help. The best that can be said about the markets is that they never force you actually to hit the wall. 1929 was not the actual wall. Neither was 2007, nor was 2000. All three of these events occurred long before the actual mathematical wall was reached. They happened because the markets sussed out that all the game playing was never going to be voluntarily curtailed, and that the frauds embedded in that game playing would continue forevermore. In other words, the inevitability of the outcome became apparent to the markets, and it was that determination, a purely psychological matter, that resulted in the various crashes. If you remember, the CEO of Citibank infamously said that while he knew the music would stop, while it's playing, you have to get up and dance. The firm was nearly destroyed by doing this, and many other banks were destroyed, including Bear Stearns, Lehman, IndyMac, Washington Mutual, Wachovia, and more. General Motors only survived as a result of a massive, unfunded bailout by the US government. The market didn't go down a bit. It lost roughly 2/3 of its value, a plunge which was only arrested when Congress literally threatened to legislate fraud and force it upon FASB, convincing them to allow fraud in accounting, specifically asset values, on a forward permanent basis. The direct consequence of this was that absolutely nothing got actually fixed. Nobody went to prison for these frauds. The people who got reamed were the shareholders and in some cases bondholders. They lost everything as a direct consequence of these frauds, and there was no compensation for them. There is a known hard date out there, 2024. I've said this before and I need to repeat it. By 2024, Medicare, which currently spends about $1,100 billion a year, yet only takes in about $250 billion, will run out of treasuries it can redeem with the US Treasury. This will force the Treasury to issue the shortfall into the public market, since the US Treasury has no money and operates on a perpetual deficit. It is a known fact that this is going to happen. When it does, Medicare will be short some 75% of what it needs to pay. This will occur approximately 6 years from now. This is also a known fact. While the actual end date might move a year or two either side of this date, it doesn't matter because, once again, the market never lets you actually hit the wall. This specific problem is especially severe, and here's why. Unlike the housing market, which represented just a few % of the economy, and houses were not being sold at 4 times their value, and unlike the tech crash, which was powered by a few dozen crazy stock market plays that had no real profit prospects, this sector is 20% of the economy, and the people over 65 really are spending the Medicare funds in hospitals, doctors' offices and pharmacies. These are not loosey-goosey numbers on a screen, as was the case in 1929 and 2000. And we're talking several times the size of the real economic impact from the housing mess. There's no escaping this outcome. A complete detonation of the federal budget and asset markets, other than a dramatic and immediate reduction in the cost of health services and products. That's just not going to happen. So-called bending the curve won't do it, nor will tiny incremental changes worth $1 billion over 10 years or so, for example, $100 million a year. What's needed would be an across-the-board immediate reduction in cost for everyone, whether government or not, in the healthcare space by about 80%. In other words, healthcare would have to be reset to approximately 4% of the economy instead of the nearly 20%. It is now, and you cannot wait until the actual collapse in funding comes, or you're going to kill at least 10 million Americans when the checks bounce. The problem with exponential explosions of this general sort is that very small changes in economic outcomes can accelerate the timeline dramatically, because these timelines are always predicated on things continuing as they are, i.e., no recessions, no serious disruptions in the global economic environment, and, importantly, no wars that cut off resources or otherwise constrain commodities, such as oil. For instance, were we to have a recession in or before 2020, the odds of that causing an immediate acceleration such that Medicare blows up 1 or 2 years from now instead of 4 would be extremely high. In turn, the odds of the market deciding not to wait the 2 years to react would go to nearly 100%, and what would otherwise be an ordinary market downturn and recession will likely turn into economic and market destruction worse than the 1930s.